is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. Let's talk about the estate planning process. It is common for people to put off planning their estates. After all, no one wants to anticipate his or her own death. In addition, many people may believe that only the wealthy require estate planning, or that all that is involved is tax planning, which can be done later. They may well be wrong on both counts. Your level of wealth and the ultimate tax consequences of your estate become secondary to the planning and care of your family and your other heirs. A well-structured estate plan can be invaluable. Through it all, you can control the distribution of your assets and possessions, as well as name guardians for your children or plan care for other dependents. While estate planning process can raise some difficult emotional and personal issues, your heirs will be glad you did it, and you will know that your wishes are assured. So, how to begin? Your first step should be to assemble a competent professional estate planning team. Your attorney, financial professional, insurance agent, bank trust officer, and accountant are all possible members of your team, depending on the size and complexity of your estate. They can help you complete an analysis of your current estate by looking at your financial position as of today and help you analyze your family's needs for the future. Does a family member have special needs or require medical attention? How much will an education cost when your children reach college age? How will your family's overall cost of living requirements change? How will your estate taxes affect your assets as they're currently held? The answers to these questions can help you develop an estate plan that will adequately provide for your family's needs. So, what information should you have gathered? A thorough estate analysis requires gathering any and all materials involved, current or future income, property, ownership, insurance, and legal arrangements already in place. This includes records of the following: current income from employment and all investments. Should also have any expected deferred compensation, all retirement benefits from Social Security, including survivor benefits, IRAs, pensions, and profit sharing plans. Should also have investment documents, certificate, passbooks, etc. Deeds to primary and vacation residences, personal property, life insurance policies of which you're the owner, the insured, or the beneficiary. Should also have your trust agreements, if any, your will if you have one, current and expected debts and obligations, including mortgage and loan balances, real estate liens, taxes payable, consumer debts, and estimates of funeral home costs and estate settlement expenses. Once you assemble all this, a complete analysis can begin, giving you the basis for a comprehensive estate plan. So here are the steps to estate preservation. If you begin planning in a timely fashion, there are methods that may allow you to take the steps to preserve your estate and minimize estate taxation while satisfying both the IRS and the courts. You can also potentially save your heirs needless effort and expense. Consider the following steps. 1. Use your applicable exclusion amount to the fullest. Current law, as revised by the Economic Growth and Tax Relief Reconciliation Act of 2001, also known as ECTRA, allows for the exclusion of up to $2 million in estate assets from taxation per person in 2007. When used properly in an estate plan, the applicable exclusion amount can help protect many estates from all estate taxes. ECTRA also increases the applicable exclusion amount incrementally until it reaches $3.5 million in the year 2009 and its eventual repeal in 2010. ECTRA is scheduled to sunset on December 31st, 2010, unless Congress takes action. You may also want to plan a gifting program. Further tax shielding is gained through the use of an annual $12,000 gift exclusion, which is indexed annually for inflation. This allows gifting in the year 2007 of up to $12,000 each to a number of donees annually without payment of gift taxes. When a spouse is involved in the gifting program, the annual exclusion will increase up to $24,000 per donee, indexed for inflation. Provision must be made for the immediate use of the gift by the donee. Gifts of future interest will not qualify. Professional assistance and careful structuring of gifting program are therefore essential. Another thing you want to do is draft a will. A will is a formal legal document instructing your survivors in the settlement of your estate. It is crucial to the success of your estate plan that your will be properly written by a qualified, experienced legal professional and witnessed simultaneously by two parties. Also, establish a trust. Utilizing trust can be an excellent method of accomplishing long-term estate planning goals. Trusts, while seemingly complex, are simple, very powerful tools designed to help individuals, like yourself, handle a variety of family and tax-related problems. Also, plan your charitable bequests. The value of all property transferred for charity, charitable, or public purposes is deductible with certain limitations when determining valuation of an estate for tax purposes. Also, utilize life insurance to the fullest advantage. Life insurance can fulfill two important functions in your estate planning. First and foremost, it can provide for the immediate cash needs of your spouse or other beneficiaries. Second, and equal importance, the use of an irrevocable life insurance trust can prevent inclusion of your life insurance proceeds in your estate and help your executor pay your estate taxes, your estate tax bill, without having to sell estate assets. And title your assets properly. The simplest and least expensive estate planning technique for married couples is to take title to assets as joint tenants. Joint tenants, this will exclude assets from probate and may eventually save legal costs. Something to note for residents of community property states, you should remember that all income and assets acquired by a married couple living in those states, except for individual gifts and inheritances, are considered community property, half of which is included in each spouse's estate valuation. But to leave, always remember you can't take it with you. The careful planning of an estate can require a great deal of expertise. If you surround yourself with a professional, supportive team as you begin the process, work through its many stages, and adjust your plans over time, you can prepare yourself and those you love for the future. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive a weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.